The federal estate tax exemption in 2026 is $15 million per person, or $30 million for a married couple. It's the highest it's ever been, which means that for the vast majority of families, federal estate tax just isn't something you need to plan around. But that doesn't mean estate tax planning is irrelevant. It just means it's relevant to a much smaller group of people than most folks assume. And there's a smaller group still who don't need to plan today, but should keep an eye out on this as their net worth grows. In this video, I'll walk you through a quick history of how we got to today's exemption amount, who actually needs to plan for estate taxes in 2026, and why some people under the exemption, including Silicon Valley founders and high earners, should still be paying attention. Now, one caveat, at Cookman Law, we don't do high net worth estate tax planning. But we get asked about this frequently, and we wanted you to have a better idea of who really needs to do this type of planning. We can also recommend attorneys who do specialize in this type of planning. Okay, so let's look at the history of federal estate tax exemptions. Why does this exemption change so often? Well, it's a political issue. Some politicians want to repeal it. Others want to lower it to reduce wealth inequality and raise revenue. So it's often included in larger budget deals. And these rules frequently sunset because permanent laws are hard to get through the Senate. So you know what? This keeps estate planners on our toes. Okay, so let's start in 2001. At that time, the estate tax exemption was $675,000 per person, and the top rate was at 55%. So from 2001 to 2009, there was a gradual increase under the law. The exemption climbed from $1 million to $3.5 million over the decade. Then it was set to sunset back to 2001 levels. But in 2010, that was the year with no estate tax, the exemption fully expired for 1 year. However, capital gains tax treatment was rough that year, so don't get too excited about it. So then we have a 2-year budget deal in 2011 and 2012, where the exemption was $5 million and the top rate was just 35%. This also introduced portability between the spouses. So then we get to the end of 2012 and going into 2013, that was the first permanent fix. The $5 million exemption was made permanent, indexed for inflation. So it was already $5.25 million by 2013. And the top rate was 40%. And I think even more importantly, portability, or the ability to transfer the estate tax exemption between spouses, became permanent. All right, so now we're at 2018, where the Tax Cuts and Jobs Acts doubled the exemption. So now the exemption is roughly $11.18 million per person. Then it climbed with inflation up to $13.99 million by 2025, and it was set to sunset at the end of 2025 back down to about $7 million. But then the One Big Beautiful Bill Act was passed, and there was a permanent fix in 2026. This set the estate tax exemption permanently at $15 million per person, indexed for inflation. So there's no more sunset, and that amount will keep climbing with inflation until Congress acts again. So here we are in 2026. We have an estate tax exemption of $15 million per person, or $30 million per married couple, and we have portability. Our top percentage rate for estate tax is 40%. Now, only 0.2% of Americans have this kind of wealth. I want to now talk about state-imposed estate taxes, because some states have their own estate taxes. And these states include Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, Oregon, Rhode Island, Vermont, and Washington State, plus the District of Columbia. Every state taxes its residents differently. Note that California, where I am, does not have a state estate tax. So we have this funny saying that you should live in Washington State since they don't have payroll taxes, and you should go shopping in Oregon since they don't have sales taxes, and then die in California since we don't have state estate taxes. Keep working your way down the West Coast. So what's the timing for reporting and paying federal estate taxes? Well, if you have a taxable estate, you need to either file a Form 706, an estate tax return, within 9 months of the deceased person's date of death, or you can file a 6-month extension and pay the estimated taxes. So now, what does it mean to plan for estate taxes? So for a married couple, you usually don't have to pay estate taxes upon the first death. There's a marital deduction if both spouses are U.S. citizens. This means everything goes to the surviving spouse free of estate taxes. Yay! Also, if you're a married couple, you can elect portability. Like I described before, when the first spouse dies, the surviving spouse can elect to port or transfer the deceased spouse's unused estate tax exemption to the survivor. This way, the surviving spouse has twice the estate tax exemption and all of the money. Note that this doesn't work for unmarried couples or for registered domestic partners. I once had an unmarried couple as clients who decided to get married so they could take advantage of the marital deduction. Hey, whatever gets you there. If you have a taxable estate over $15 million per person or $30 million per couple, and you don't want to pay taxes on that overage amount, you can give away control or ownership of some of your assets at a discount rate to get below that amount.
Did you know my mom has a monthly newsletter where she shares helpful information? Click below to join.
So who needs to do planning for estate taxes? Well, here are some scenarios where you might need it. You might need this planning if you're single and you have an estate of over $20 million, or you're a married couple with an estate of over $40 million. Now, why don't I say $15 million or $30 million? Well, you still need money to live on. Once you give away your money, it's gone for good. Do you want to take the risk of giving away a lot of money and it affects your quality of life? Or you're relying on your kids to take care of you? Probably not. So another scenario you might need this planning is if you're young and you have an estate that's approaching the estate tax exemption and your investments are doing well and you anticipate that you'll exceed the estate tax exemption soon. Another situation is if you're a California resident, but you own property in a state that imposes state estate taxes. So you should usually complete your estate plan in California, but then you can consult with an estate planning attorney in that other state where your property is held to see if you need to do specialized planning in that other state. Another example might be if you have a large estate with mostly illiquid assets. So if you have lots of valuable real estate, for example, that's worth more than the estate tax exemption, but not a lot of cash or liquid assets, upon your death, someone might need to quickly sell one or more of your properties. You may not get a good value if you have to go through this type of fire sale. All right, so one option you could do is to set up and fund an irrevocable life insurance trust, or an ILIT. That's where you set up a trust that buys a life insurance policy on your life or on somebody else's life. And upon the death, the proceeds stay in the ILIT outside of your taxable estate. So let's say you have a $20 million estate and the estate tax exemption is $15 million. So you have $5 million in estate tax exposure, and you'll have to pay 40% of that, or $2 million in taxes, if the estate tax exemption remains the same upon your death. Well, this isn't ideal. So you might decide to get a $2 million life insurance policy in your name. Upon your death, though, that will increase your taxable estate to $22 million because it's includable in your taxable estate. Then your estate will need to pay estate taxes on that additional $2 million. That kind of defeats the purpose of the policy. But if you get a $2 million life insurance policy owned by an ILIT, when you die, the proceeds are still held in the trust, which is outside of your taxable estate. The $2 million in the ILIT can then be used to pay the $2 million of estate taxes. Now, you might not yet need estate tax planning, but you should keep an eye on your total net worth and on the estate tax exemption, since you might need this planning in the future. So there's two types of categories of people who might be in this situation. We call them Henrys, high earner, not rich yet. So you might be making a lot of money, but you're still pretty young and you have high expenses. Hello, kids, right? So you haven't been able to save a lot of that, but you do anticipate that your savings will grow a lot over the years. Our practice is located in the Silicon Valley, and there's a lot of founders here who might strike it rich in the future. If you have a liquidity event or you have ownership in a company that goes public, you could suddenly have estate tax exposure. Keep an eye out for this. Why do I say keep an eye out for this as opposed to diving right into planning? As I mentioned earlier, estate tax planning often involves giving away control or ownership of your assets. And this is something a lot of people are unwilling to do. And when you give it away, there are no takebacks. Okay, so we saw this happen in 2012. The estate tax exemption, remember, had gone up from $1 million to $3 million over a 10-year period, but it was about to plummet back down to $1 million. I was working at a firm where a lot of clients came in and they were worried about owing estate taxes. So they did sophisticated planning and gave away a lot of assets or put those assets in irrevocable trusts. Well, guess what happened? In 2013, the estate tax was permanently set at $5 million. So those clients didn't actually need to give away their stuff in the first place. Believe me, there were a lot of unhappy clients who came back to undo all of those irrevocable trusts and transfers. It was a mess. So if you're watching this and you're thinking, okay, I don't need to worry about this, you're probably right. But if you're in that smaller group where estate taxes might be relevant now or down the road, the best thing you can do, I think, is to stay informed and start the conversation early. We don't do high net worth estate tax planning at Cookman Law, but we can absolutely point you towards attorneys who do.
If this video is helpful for you, share it to someone else who might benefit from it.